journals of traders back at the time of the market movement in the 20s. And they talk about these levels at which they would get into trades. And those levels of support and resistance exist and have existed beyond and before the existence of electronic charts. When I started trading, kind of almost by accident, by kind of sidestep into it, back in 1984, electronic charts were not widely available. So I started paper trading, literally writing down prices, closing prices out of the newspaper, paper trading, on a legal pad, and then telling my dad, hey, we need to buy this or we need to sell this because of where it is relative to previous price movement, tracking it over time. So those levels of support for a long period of time, we can use those to our advantage. Now here, 40 years later, I'm on stage talking about this. So I think that's kind of cool. We'll talk a little bit more about that tomorrow when we get into options. But what I want to do really quickly is we're now about 5 minutes after Cameron May, who's one of our great coaches, is now teaching advanced charting techniques. And I wanted to show you a little bit about what this webcast looks like and feels like when you're in that webcast. So we're going to jump in here really quickly. I'm not going to talk very much. I'm going to let Cameron's audio play, but I'm going to announce our presence in the chat, and you'll see what that chat looks like as well. So I'll just jump in here, and we'll take a look.
Concept, we have an idea for managing profits, for managing losses, and then the trade just decides, let's just dust Cameron out of this trade just quickly. And then off it goes, making its way, it's higher now than it was, making its way potentially toward our target. But yeah, we actually got stopped out on this on a pretty tight stop. We didn't take much risk here, didn't have a large loss there, but out of the trade, that one's done. Now, let's now look at some happier news. And this trade is actually more than enough to make up for the two that went south on us. We had a position on Costco. Robert, you've actually had a whipsaw before? Yeah. I know. Yeah, it happens if you traded for any amount of time. Ocean Life said they had a whipsaw on Walmart. Yeah. Okay. So with Costco, this one's just been plain old cooperative since entry, right back here on January 3rd, took a position, again, with a relatively tight stop and a relatively aggressive target. And in this case, off it went, got some legs, hit our target, we're back. And then it's kind of blasted on beyond that. So we left a little bit of money on the table, but a nice little target hit. Now I'm gonna hit the pause button right there because I just saw some in the chat kind of raise my eyebrows. We're being joined right now by about 500 people out there in the Atlanta Technical Analysis and Options Live Workshop. So hello there, Atlanta. Let me say hello to the instructors as well. Hi there. Ben and Ray and Scott, guys, you have a great crew working for you. I hope you're paying attention in that webcast. Also got to say, I pay attention to stuff like, I happen to know it's Ben Watson's 20th anniversary right now as a coach today. The majority of those 20 years, I started 3 months after Ben did, so I'm coming up on my own in a couple of months, 3 months. But everybody out there in Atlanta, enjoy the workshop. We're talking about technical analysis here in this webcast as well. So let me get back to the final position.
So you get a sense of what these webcasts look like. You get to participate in the chat over here in the chat column and ask questions on an ongoing basis if you are in the live webcast. If you're watching this in the recorded version, because we know, hey, you can't always be looking at webcasts and paying attention during the middle of the day. Some maybe you can, but you get the opportunity to watch these in the recorded version after the fact. You can participate in the conversation there as well by leaving comments in the comment section, and then we will respond to those as quickly as we can. So you still get to be part of that discussion. What I would encourage you to do, whether you go into one of the live webcasts or whether you go into one of the recorded webcasts through our webcast page here on the YouTube channel is click on this subscribe button. Right there at the page, you'll see it on the webcast, on the live webcast, you'll see it right here. Click on that subscribe button. That allows you to stay connected to the community. It allows you to set up alerts when new webcasts drop, when those archives get posted. And I'll tell you what, I mean, I have a lot of subscriptions in my life that I've subscribed to, streaming services and everything else. This is probably the one that pays you the best because you get that education and it doesn't cost you anything to do it, and it's a great subscription. So follow along with that as well and learn a little bit more about what's going on. So now what I want to do, now that we've kind of set that up, again, you've got those resources available to you, and those are, again, where you extend your learning from today's discussion and from what we've been doing. So let me bring this back. I'm going to kill Cameron's webcast here just so that we're not pulling that bandwidth. By the way, I know that the hotel and our AV staff have been working on the Wi-Fi at lunch, so hopefully it is better, working better now. If you are still experiencing some problems, grab one of our staff and we can help to resolve that a little bit as we get going. So now what I want to do is I want to come back into this discussion and I want to talk a little bit about how we pull all of this together, because what we're going to be doing from this point is really kind of pulling these ideas together. Pulling together, first of all, levels of support and resistance as they come together or diverge from one another. And how that may help us to make decisions, right? Because those decisions, the if, this, then, that statements, have to come down to some kind of criteria that says this is or it isn't something that I can take action on, right? So we talked about trend being one of those. And maybe the easiest definition for an if this then that statement is if the stock that I feel comfortable buying is in an uptrend, then enter the trade. And if it's in a downtrend, then exit the trade, right? And we wait until one of those two circumstances exists. Then we added the concept of levels of support and resistance. So now we can make it a little more complex. We can say, if the price is in an uptrend and it's bouncing up off of support, or it's breaking through resistance, then enter the trade, else wait, right, for that circumstance. And likewise, if we're in the trade and price breaks a level of support, then exit the trade. And then we might add a little bit more definition to that discussion by saying, well, if it breaks that support level by a certain percentage or by a certain amount or with a certain candlestick, then exit the trade, else wait. And then we added candlesticks in the mix, that momentum understanding. So if price is bouncing up off of support and showing momentum with a big candlestick or the RSI moving higher, and the stock is in an uptrend, then enter the trade. So we're using this process to kind of continually refine our definition of entering and exiting trades. Somebody asked me the question, well, on the Thinkorswim platform, can we get down to that granular level of building out or translating that if this then that statement into a complex series of conditions that might exist for the stock in order for us to enter the trade? Or, by extension, could we search for those characteristics? And the answer to that is absolutely yes. So we'll look at that a little bit, but I'm going to bring Ray up first, and then I'm going to bring Rachel and Scott up, and we're going to talk through putting some of these things together into some trade examples. So do me a favor, if you wouldn't mind, and give me another big round of applause for Ray Kimbrell as Ray comes back here. Hi, Ray. How are you? So, I think we'll keep them going. Now, we're going to talk about price patterns. Now, as we've been talking about all of these things, trends, support, resistance, momentum, I've been bringing in kind of this idea of mythology, right? There's so much mythology out there in the market. This is one of those areas where there's a lot of mythology, right? The myths of things like gaps filling, or the myths of of price patterns that it has to do this or has to do that. And the answer to this is the price of the stock doesn't have to do anything. We have no way of predicting what it's going to do next, number one. And number two, we have no way of controlling what it's going to do next. So all we can do is gain a probable edge based on seeing what has happened before and translating that into something that is likely, but not guaranteed ever, to happen again.
I know some people don't feel that way. How many of you, like every time you get into a trade, the stock goes down? See? There's some folks that happen, so you know.
It's because the market hates you. It doesn't, but it doesn't know who you are, quite frankly. But that happens. It's happened to me. So let's just kind of ask the question: what do you suppose is going on in that type of circumstance that maybe was overlooked? If you get into a trade and then the price turns around and goes down deep, what do you suppose the condition was when you got into that trade? Where was the price of the stock relative to something that starts with and ends with resistance? Probably at around the level of resistance. And it turned around and went down.
What was the trend?
Oh, or the trend was already down.
Yeah.
You got on the bus thinking it was going to go up, but in fact it went down. It went towards Macon instead of going towards Savannah. Okay. Or the other side of that coin is, how many of you have gotten out of a trade and then it went bing? Probably maybe more so that way, right? You got in or you got out of the trade and it turned around and went higher.
They need to be calling me ahead of time so I can take advantage of that.
Right. Yeah, okay. And that's very likely because we were ignoring something that starts with S and ends with the port, right?
There you go.
Support. So we got to pay attention to these things. Now, the interplay of those helps us to see what's going on. And again, you're going to see that this comes down to trend and support and resistance as we define these tools.
Back what we said this morning.
Yes,
All rolls right back into that.
it does. So Ray, let me pop forward one more slide here, and let's talk a little bit about this in terms of price pattern.
Yeah. So you see up there, there's 8 of them, I believe it is. Yes, 8. And in the past, I know Ben and Scott were a little nicer than I am. They said, you don't really have to memorize all the names of the candlestick pattern. Yes? I heard that right? Just go with the story, correct? Right? You remember hearing that this morning? Hello. Yeah. And this is after lunch, so we got to do like the interactive thing. All right? Or I don't think y'all are sleeping, then I'll have to get you up doing exercises. All right? Spring core thing, we'll get woke up. All right. So there's 8 of them up here, right? So you need to memorize these. This is a class. They're all.
Ray, I think that would take a little bit too much time to memorize every single price pattern.
Oh, those 8.
Okay.
Those 8.
Well, there's some common characteristics.
Yeah.
I mean, that's like, look, Ray, that would be the difference between saying, all right, let's have everybody stand up and introduce themselves and tell us where you're from and what your motivation is.
Ooh, good idea. Oh, yeah, great. Yeah.
There's a reason why all of you are here in this room, and it's to learn how to make money building your portfolio, right? So we can kind of generalize some of these things here when we talk about price patterns. So let's do that.
So I make a little light of that, but honestly, it wouldn't be that hard to memorize. But and again, back to like the candlestick patterns. Know the story. I think that's a good way y'all taught that. Know the story, what it's telling you. And here's the thing. You're going to see some of these patterns where you go live here a little bit and show you some live ones. And they're not going to be exact pretty like drawn up here in a drawing. But look close, and you go, okay, now I see. Right?
Oh, the bears.
But just know that there won't be always exact pretty as you see a drawing here. But you got to know kind of the story of it. Now here's the thing. Now these are called bullish price patterns. By the way, you have all these slides. When you go to the email, when you registered, you got your confirmation email, and you got your email to come out here yesterday, I think. In that email, embedded in there are the links to all of the slides that Ben has been using even stuff that he hasn't been using, okay? So you can take pictures of them, that's okay. But just know you do have all these slides, all right? You have all of them, right? Ouch, that could. All right, so here we go. Bullish price patterns is also a slide that says bearish price patterns. All right, but this first one, bullish price patterns. So bullish, you know, bull, horns up, right? Bear, claws down. So these are all upward trending price patterns. Now the first ones though, it says reversal. We mean reversal. Well, the reason why it's called a reversal is the trend going into all three of those patterns is down. The trend going to all three of those patterns is down. And then the next question you can get, Ben.
Yes.
Well, what time frame are those patterns? Right?
Oh.
How many of you wonder what time frame those patterns are in? A few of you wondering, yep, it's all time frames. You can look at those patterns as a longer time frame, intermediate or short term, doesn't matter. You can use them, they spread out over all aspects of time frames within the within any kind of stock.
Right.
And we'll show you some of those as we go along. All right. But the thing that's true about all of them is what is the trend going into it? Okay, what's the trend going into it? The top three, the trend is down. The trend is going down into the pattern, and then it hits this level. This thing that Scott Murphy was up here bouncing his ball, calling it what? Support, okay? Hits that support level, and then it does something unique. It bounces off the support level, goes back up. You guys been talking about that the whole time, yes? All right, then it hit a level of resistance, came back down, hit support again, went back up. So that first one, it did it twice. Hit the bottom twice. Hit the bottom twice. Double bottom. See, even a Marine can figure that one out, right? All right, so it ain't that hard, okay? So double bottom, and then the key thing on the double bottom, why it's so unique, not unique, why it's so important to recognize it, is it broke through something. What did it break out of? Break through? It broke through what? The resistance level. It broke through it. Okay? And then what we say, old resistance becomes new support. Okay? So if you see this pattern forming and you see that break, could that be maybe an if-then statement? All right? If you see this, you see that pattern, right? And if price breaks resistance, then what? Call Ray. Well, I don't have to find him, right? Or call Ben. No. If it breaks resistance, then what? Enter the trade. That might be the if-then. It could be the if-then statement, right? Question. Okay, so the question is in general, what time? We just did that a minute ago. Remember what time frame, folks? All the time frames. All right, so if you're a longer term, maybe it's several months it formed that. Or maybe if it's a short term or trend, you see that pattern, maybe it's a couple of weeks it formed, okay? But good question. And yeah, so all time frames. Very good, very good. All right, and then this head and shoulders thing, you got to be a little inventive, okay? Got to be thinking a little bit differently. So in this case, it's a downtrend. It breaks through, it comes through the level of resistance. All right, then it before it got all the way down to support, it reversed back up. Hit resistance, came back down, and then the second time it did go all the way down to support, hit that support level, bounced back up to resistance, came down, but instead of going all the way down to support, it reversed early and back up. Shoulder, head, shoulder, okay? But the key is what? What's the key thing in that pattern? As in all of them on top. What is it? It went back up and did what? Broke through resistance. Yes! Give her a hand. Maybe extra cookie. There we go. Very good. So that is the key thing. You already figured it out. 3 examples and you already got it figured out. All right. Key thing is what? What is the trend going into the pattern? The pattern that it made, and then it broke out of it. Okay. And it broke out of it. Now, we'll get into this a little bit later on. But the other cool thing about these patterns is it can give you a kind of a look.
Yes.
Into the future. There is no guarantee. Okay, there is no guarantee. But you can use these patterns to help gauge time and distance that the price may move. A lot of times what you'll see is if it took, let's say, 2 weeks, back to the time question, right, which is a good question. Let's say it took 2 weeks to form that triple bottom. They went down 3 times, finally broke out, took 3 weeks, and let's say the difference between support and resistance was $10, just for fun. That little distance right there. Let's say it was $10.
Okay?
All right?
I'm
So,
with you.
what a lot of times you'll see this reoccurring is that then it'll take 2 more weeks once it breaks resistance to get to that $10 level.
Wait, let me see if I understand what you just said.
Okay.
You said that it maybe takes the same length of time to get to the expected move
Yes.
that the price pattern implies that it took for the price pattern to be created.
Correct.
Okay, first of all, good, I like that.
Yep.
There's some nice symmetry to that.
Yeah.
The price takes the same length of time to get that same distance. Now, the other part of that is what you said about the distance. You said that if this were a pattern that maybe moved 10 points between resistance and support, that it might be 10 points to the upside once it breaks out of the resistance,
Yes.
and it might take 2 weeks to get there.
Yes. So potential target. Now again, the key word there, potential. I mean, it's going to get there. By no means are we saying, and you see this, that yes, in 2 weeks it will be $10 higher. Wish you could say that. That would be a cool thing, yes.
Yeah, and the other side of that point is, it doesn't have to take 2 weeks necessarily to get there, especially if there is something like an earnings announcement driving momentum.
Or it
It
could-
might reach,
Or it could take 3 weeks.
or it could take 3 weeks.
Right.
Not too particular, not too precise, right?
But why is that? Why do we bring that up? Well, tomorrow we're teaching this thing called options, right? And options have an expiration date. They all expire eventually, right? Who's heard about options? Oh, nice. Who's heard the risk? Yeah, nice. Okay. Trading stocks is what you're doing, right? All right. So who's coming back tomorrow for options? Who doesn't know yet?
Will you have the Wi-Fi working then?
Will we have the Wi-Fi? Who messed that? Who messed that? No.
Yes, you would.
No, hopefully we will. Believe me, we didn't plan for it to go down today either, okay? Just like you said, there's no guarantees right now. So hopefully it will be.
So let me summarize this again, Ray. So if we've got a pattern that does something like this, right?
Yeah.
And it bounces, let's say it makes that double bottom pattern and comes off of a level of support, and we might say, okay, there's the distance that it's moved in between levels of support and resistance.
Right.
So let's say that's 10 points, that we might expect that this would move up a distance of 10 points to the upside, and it might take the same length of time, just to kind of summarize.
Right. So the reason I'm bringing that up, if we come back tomorrow and we get into the options discussion, and they have expiration dates, we'll get more into that as we get tomorrow. But wouldn't it be kind of nice to have a planning tool that if you know it's going to potentially take 2 weeks, 3 weeks to get there, that you might need to have at least that much time in your option to give the option the time to get there? What do you guys think? That's kind of cool, yeah? And who would think that's even better if you understood what I just said? All right? So, that's why you want to come tomorrow, because we're going to get into some of this kind of information that says, well, we're going to bring it up. Remember, tomorrow we're going to say this. Remember yesterday, we talked about the patterns, and it took 2 weeks to get there? Okay, you'll hear it tomorrow, right?
And you mentioned 2 different kinds of traders that we've talked about today. Trend traders
Yep.
and swing traders. Swing traders typically trading between a level of support and resistance. So if we're looking for the stock to make a move that's equal in distance to the move that it made from resistance down to support, once it breaks that resistance up to the next level of resistance, that might be applicable to a swing trader mentality, looking at taking that difference between the resistance level and the next resistance level overhead, right? So you might say, fine, I'm willing to get into the trade when it breaks resistance and then exit the trade when it gets to that next level of resistance. Or add to the position if it moves up beyond that next target. Now, a trend trader might look at it differently. A trend trader might say, fine, I'm going to use this as an entry signal, but I'm not going to put a target price to exit until I see the trend change. That's the difference between a swing trader and a trend trader. Question? Okay. Oh, phenomenal question.
Yeah.
So
So,
go
you
ahead.
hear the question, so we're looking at a time frame of a longer time frame here, potentially like weeks we talked about. Her question was, well, if I'm trying to scalp and kind of maximize that entry or exit point, can this be, are these reliable patterns, reliable on a shorter term, like a 5-minute chart? Okay?
So you remember what we said about the difference between the candles on a 1-minute chart or a 5-minute chart versus those candles on a daily chart versus a weekly chart? Those faster candles, the shorter time frames, incorporate less information. So, by necessity, just by pure creation of the candle, you're going to get a quicker signal, but it's going to be by nature less reliable because it incorporates less data, more likely to not do what we expect it to do. The longer period of time may be, but no guarantees, more reliable as a signal simply because it incorporates more data into that candlestick. So then if that's the perspective on trading, you're looking at trading that short-term movement, would you be more aggressive in managing your risk or less aggressive in managing your risk if that was potentially a false signal? Probably more aggressive in managing your risk. Longer-term trading may let that risk be a little bit larger because if you're getting that signal, you may want to give it a little bit more flexibility. So we'll see how this kind of plays itself out, but I think that's a great question to ask question here. Okay. Oh, yeah. Okay. Great question. So the question was this: what kind of time frame might be a time frame that many traders could use as a means to make entry and exit decisions that has pretty good reliability? It doesn't require me to wait a long period of time, or it doesn't get slow signals, right? So we can speed it up. So maybe here's the answer to that, right? It depends on how long you typically tend to stay in a trade. So I know that's the ambiguous answer, but let me give you a more specific answer. By and large, most retail traders look at daily trade information, daily candles, simply because that incorporates whatever the news for that day is, right? And you know, we think about news cycles and how fast they move and how that moves price action. Typically, daily candles are a reasonable time frame for us to digest that information. If we are more active and more aggressive at recognizing that we're going to get more false signals, shorter term time frames are going to be more reactive to current pieces of news. Longer term time frames may certainly, if you're looking at weekly candles, may certainly be an entry or an exit signal for somebody who is trading things like fundamental characteristics. Because we think about what's the one scheduled news item in the lifespan of a stock that we know that comes around every 3 months? Earnings. That changes the fundamentals of the company, oftentimes, because that's new information being presented. So if I'm a long-term trader or a long-term investor, I may be trading weekly candles simply because that's more reflective of that quarter-to-quarter, earnings-to-earnings type of mentality. Daily candles if I'm more reactive to what's going on in the news today. Shorter-term candles if I'm looking at minute-by-minute flow of news and taking advantage of that price movement. Does that answer that question? Okay.
All right, so these bottom 5, remember you got to memorize them. All right, flag pattern. Right, so the flag pattern looks similar to the triple bottom, doesn't it? We're kind of at a slant. You see that? What's the key thing about the bottom? What do you think the key thing is about all the bottom ones? It's called a continuation pattern. Starts with a trend. Starts with a T. Trend. All right, what's the trend going into all 5 of those patterns? Oh, the trend's up now. So the trend is up. You already have that uptrend going on, okay? So, tend to stay in that, the trend tends to stay in that trend until it doesn't. Okay, so the flag pattern, you got 2 pretty much parallel support and resistance lines kind of angling down, right? Bouncing in between. All right, but what is the key thing there? Broke through resistance, still going up. All right, pennant pattern. You got a angling down resistance and an angling up support. Okay. All right, and so in that case, again, it's kind of squeezing. The price is getting squeezed until it's going to do something. It's going to pop. Who's ever had a watermelon seed and you pinch the watermelon seed between your fingers really hard, and eventually it does what? Come on, y'all from Georgia. Y'all should know these things. It pops out of your fingers, right? And it either goes which way. It goes up, it goes down somewhere, right? So it's kind of the same thing on this one. It's getting squeezed, and then bing, it's going to go somewhere right in the eye, right? So it's going to pop up. In this case, it breaks out to the upside. Breaks out, keyword, breaks out to the upside. What if it broke out to the downside? Would it be a continuation pattern anymore? No. It'd be a reversal. Very good. Very good. All right.
So, Ray, I want to take this example, either the flag or the pennant pattern or an ascending triangle, for instance, right?
Okay.
So we've got the trend coming in,
Yep.
and then we've got something going on with levels of support and resistance.
Yep.
Maybe we've got a horizontal level of resistance, or maybe we've got a declining level of resistance. But at some point, those 2 things, as you said, that squeeze is happening.
Yep.
Support and resistance are coming together. What does that suggest about the opinions about price between buyers and sellers? They're getting closer together. So when you start to see that confluence of levels of support and resistance, what types of candles are you likely to see when prices are getting closer together? Equilibrium candles. Oh, okay, that might be a clue when you start to see levels of support and resistance as you've drawn them in. When you start to see those candles shrinking, and maybe larger wicks or shadows top and bottom, there might be that equilibrium. And then at some point, theoretically, one side or the other gains momentum. Either the buyers do, and it becomes a continuation pattern. Or the sellers do, and it becomes what kind of pattern? Bearish reversal pattern. And it turns around and goes down. So when you start to see those confluences or convergences of levels of support and resistance, pay attention. Attention must be paid, as Stephen Sondheim says in his musical Assassins. Attention must be paid at this point when those levels are coming together, because that can tell us what's likely to happen. It doesn't guarantee it. Now, there's a couple of other things that I want to bring into this mix real quick.
Another thing also, if you remember back, I think Scott Murphy said this earlier to you guys about the candlestick patterns, candles, that they have more of a telling story when the candle is forming up near 2 different levels, right? Support and resistance. We went right back to that. Ben just talked about that just now. And these patterns, start seeing them forming up at those levels of support and resistance, pay close attention. Okay? Pay close attention.
So one of the things to think about, just like that length of time that it takes for the pattern to be created, is about the length of time for it to get to its target, number 1. Number 2, it breaks out typically in the equivalent distance as the depth of the pattern. Well, there's another thing to think about. Typically, a breakout in a bullish continuation pattern isn't going to happen right there at the absolute point of that squeeze. Because that's where you get down to that kind of absolute equilibrium, right? Buyers and sellers might be exactly equal in their assessment of what's likely to happen. Typically, a breakout is more likely to occur somewhere between 2/3 and 3/4 of the distance of that pattern, the length of time for that pattern to be created. So you might get down to this ascending triangle pattern that looks like this, right? And somewhere in this range, you get a breakout. More often than not, though, if that breakout occurs down here at the end, it may be a false breakout. Some of you have probably experienced this. You get a breakout and then price changes direction and moves the other way and falls out of that pattern, and that becomes a reversal pattern. So also pay attention to where, in the context of that breakout or continuation pattern, the breakout occurs. Falls in that 2/3 to 3/4 of the length of the pattern, likely to be a solid breakout, not a guarantee. If it occurs at the end of the pattern, at the confluence, perhaps more likely to be a false breakout when we see a reversal, something to kind of keep in that if this then that statement as you construct it, right?
Very good. Yep.
Now, Ray, if we were to flip all of these over, let me just delete this really quickly here, my magic marker. And we were to
Go to the next slide.
we were to go forward. Oh, I got to put it on that first, and then we'll go to the next slide. Maybe. There it is. Okay. Now we've got bearish reversal and bearish continuation patterns. So why is this important? Well, if we are in a trade, right, Ray, and we run up against resistance, and it hits resistance a couple of times or 3 times, or maybe it goes up a little bit, pulls back, and then goes up again, pulls back, and then comes up to a lower high, and then pulls back, that could be a sign that the price or the trend is about to do what?
Reverse.
Oh, you mean the reversal pattern?
Yep.
Might indicate a trend reversal.
Yep.
Okay. And then a continuation pattern, a bearish continuation pattern,
Stay in the back.
downward trend,
Yep.
downward trend. Trend in motion, there's kind of this kind of inertia factor. A trend in motion tends to stay moving in that trend unless something is changing the circumstances, right? So trend moving down, we see a little bit of a reversal, but it becomes a continuation pattern because price continues to move in that direction.
That's it.
Okay. And if we see one of these patterns, these bearish continuation patterns, where instead of breaking to the downside, the price now breaks above that resistance and starts to move higher, what does that become? Now a bullish reversal pattern. And we look for that trend to move higher at that point. So these become important keys to paying attention to stock price movement. Question?
Real time.
Interesting question. So the question was this, well wait, when you've got this bear flag, or this bearish flag pattern, where price is coming down, and then it starts to make what kind of uptrend, or what kind of trend? A short term, is it making higher highs and higher lows?
Yep.
It's making a short-term uptrend. How would we know, or how would we recognize that that's a bearish flag pattern? What happened there to give us that indication that it then became a bearish continuation pattern with the trend moving lower? It broke a support level, right? It now made a new lower low. That's how we recognize it. So what that tells me in general terms is if I see these price patterns developing, I'm basing that price pattern on what my expectations are around support and resistance.
So for a bear flag, that is right there, that's a bear flag. Not a bull flag, that's a bear flag. Because what's the trend going into the pattern?
That's the flag, Paul. That's the flag.
No, what's the trend going into that pattern?
Well, you
Down.
already
Okay.
Down, the trend is down. All right, so are you gonna do a
You already know.
bullish trade on a bear flag?
No.
Would you do a bullish trade on a bull flag? Yes, or get prepared for it. All right, get prepared for it. Now, you'll see later on that on some bull flags, Okay? Trend is which way? Up. You get a little flag pulling back. Some folks that have a little bit more risk tolerance will enter trades when the price is bouncing off of the support level on a bull flag. It hadn't broke through resistance yet. You can do that. That's something you can do. Yeah, that's something you can do. All right? Maybe a little more gutsy. Got a little more risk there because you're not sure where it's going to go yet, right? Because it's pulling down. Okay? Or some people will look at a bull flag and they'll end the trade once it does something unique. It breaks what? Resistance. Okay? So in a bear flag, right? Tomorrow when you come in, you learn this thing called a put option. Right? Make money when the stock price falls. Okay? So some people might look at that pattern as that's a good setup for a put option. All right? But would they get in potentially when it's going up there at the level of resistance? Or do you think they might get in when it breaks support? Breaks support potentially.
Yeah.
Or depending on your risk levels. All right? At least you can identify them now. You get yourself set up, put them in a watch list, or watch it, or put an alert on it that says, hey, when this stock breaks this price bound to the price point to the downside, send me a text. That'd be kind of cool. You can't do that. Right? You can't do that.
So I think we can kind of summarize this by saying, look, if we pay attention to where levels of support and resistance are, and price does something that's consistent with the trend coming into that pattern, it's a continuation pattern. If it comes out of the pattern in a different direction than the pattern it went into the pattern, it's a reversal pattern, and we trade it as such. But ultimately, what it comes down to is having confirmation of, or evidence of price moving in a particular direction, not guessing which direction price is going to move, right? Having evidence, knowing, so this would be like, okay, I don't know which way the bus is going. I'm watching the bus in the parking lot. I want to go to Savannah. I don't want to go to Macon. I'm waiting for the bus to make a decision as to which direction it's going. And I want to get on the bus going the direction that it's headed, right? And so if I'm trading options, I might get on the bus going to Macon, maybe. If I want to go to Savannah, I want to go north, I'm going to wait till the bus starts heading north, and then I'm going to get on the bus. And it's like I said before this morning, that might cost us a little bit more, because we're getting in at a point where maybe it's a little bit more expensive. But it's already giving us a directional indication where it's likely to go. No guarantee that in the next block it's not going to turn around and start heading south. So we're going to protect ourselves, right? We're going to put our hand on the cord to exit the bus if it starts going against us. Does that make sense? Question right there and then there, and we're going to wrap this part up. Uh-huh. Yeah. I love that question. So the question was, wait a second, if I recognized that this was coming to a point, and it gave me the possibility of one direction moving that direction, that's another boy band, of going that way, or going that way, could I structure my if this then that statement to accommodate that? Could I say, if price breaks resistance, then enter the trade long, meaning buy the stock and take advantage of that upward movement, or if price breaks support, then go short and take advantage of that downward movement, else wait. Yeah, absolutely, I like that, that's kind of cool, right? And that ability to be flexible in our trend direction based on what we see with these price patterns makes a lot of sense, right? Because it gives us that ability to make a decision, not on what we hope is going to happen, not on what we imagine or fear is going to happen, but what we actually see, the reality of happening on the price movement, right? And again, we can't predict what's going to happen in the next tick, the next minute, the next hour, the next day, right? So what do? We manage our risk. I know there was another question right there. Okay. You could structure that as a bracket order. You could structure it as a one cancels other order. So if this trade happens, the other one goes away, or if this trade happens, this one goes away. Sure, we can, and we'll talk about how we would translate that into a specific trade when we bring Rachel and Scott up here in just a minute. But Ray, I wanted to do this. I wanted to look at one or two examples, and then we'll kind of wrap up this idea of price patterns. Yeah.
That's the way.
So what I'm going to do is I'm going to go out live into the wild, and we'll take a look at some of these and see if we can see them. So let me pop back over here real quick. We'll pop back over to the platform. And what I wanted to bring up here really quick, Ray, was this one, because I saw this happening the other day. And I'm going to hide our moving averages, but we know, what's the trend of this particular stock? This is Walmart. Up. How do we know? I mean, it's making higher highs and higher lows, but our short-term, intermediate-term, and long-term moving averages are all moving higher, yes? Okay, cool. So I'm going to hide those just so that we can kind of clear up the picture here. By the way, if we were to also put on here RSI and kind of get a sense of what's going on with momentum, and I'll hide that one as well. Is that showing strong positive momentum? Yeah, okay, good. So I'm going to hide that as well. I'm going to just click on that little eyeball icon right here on the study and hide that, but I can come back to it. So I noticed what was going on here. We had an upward trend, but then in this intermediate time frame, I'll just kind of zoom in on this time frame here. I'll draw this with my magic marker. Price was moving down, right? We had a downward trend coming into this pattern on an intermediate time frame basis, right? Days to weeks. Then it found a level of support, and it rallied up to a level of resistance, and then it pulled back down near, again, that level of support, and then what happened right here? At about 93, it broke out of resistance, didn't it? In fact, it did something really cool. It broke out of resistance. We had that candlestick with that big, long upward shadow. It broke out and came back and retested, just like what we saw in Disney earlier. Came back down and then bounced up off of that support level. So what's that price pattern that we just saw build itself and occur right there?
Double bottom.
Double bottom. Yeah, you could also call it a W pattern.
That's
Walmart,
why their name is Watson. That's
Watson,
why,
big, the big W.
Yeah.
The big W. Okay. That's a pretty clear example of a W pattern. Now, you want to see something really cool here? Let's do this. I'm going to close my annotations here, take those off. We'll go back and shut that down. I'm going to zoom back a little bit here, and I'm going to say, all right, fine. Let's remove that. We know where our level of support is, and I'll zoom in again. We had this level of resistance that was right about here. That's where that breakout occurred. Again, not too particular, not too precise. So watch. If I take that distance between support and resistance, and I draw that down to that bottom where that level of support was, and I right-click and duplicate on it, and I put it up here where price broke out of the resistance level. So if I draw this horizontal line across that level right here, did the stock run into a little bit of resistance and support right about there at 97? A symmetrical distance from the distance it created in the pattern? Okay. And then what did it do? It bounced off of that support level and did what? Went higher. Now, let's do this again. Duplicate, and let's put it up here. You suppose we're finding some of that resistance? Was resistance now perhaps acting as support yesterday and today? Okay. So if that price is sitting at a support level right now, and that support is kind of that symmetrical support, if price bounces off of this support and continues to go higher, could we just continue to do this? Could we just continue to say, all right, fine, I'm going to put price up here, say, all right, the next level that I might find a significant resistance on this stock is up here around 105 or 106, symmetrical distance. See how that works? Is it a guarantee that it'll get there? No. But we might be looking for evidence of a bounce up from this support level to enter the trade. If price bounces, then enter the trade, else wait. How cool is that?
I think it's pretty cool.
Yeah. Now, what I'm going to challenge you to do is look at some of the stocks that you have either in your watch list or that you already have positions on, and try to identify some of these price patterns. Keep in mind the trend direction, levels of support and resistance, and how far the stock may move coming out of that pattern.
What are the candles?
And what are those candles? Cool stuff. Real quick question here. Okay. So the question is, well, wait a second. Is this driven by algorithms for algorithmic trading? The answer to that question is very simply this. For those of you that are familiar with computer coding or software development, what is the statement, if price breaks resistance, then enter the trade, else wait? That's an algorithm, right? That is a set of code that gives us an instruction based on a set of criteria. That's an algorithm. So is this algorithmic trading? Did I just turn every single one of you into an algorithmic trader? There you go. All right, so that's exactly what we've done, and that's exactly what's happening here. Not a nefarious or bad thing. Now you see some of the power of that. Ray Kimbrell, thank you very much for helping. He puts his fingerprints on my glasses.
I do not.
Okay, I was going to have to give Ray a big round of applause, but let's get him off the stage for that organic. Wow. Hi, Ray. Thank you. All right. So now that we have that understanding, right, we have the concept of price patterns in relationship to price movement, levels of support and resistance, kind of that confluence or that bounce, that breakout, and I think this is kind of a good example. I want to bring Scott Durfee, and we've got a phenomenal opportunity because I'm also going to bring up here Rachel Dasher, who you met at lunch, but let's give Rachel and Scott a big round of applause as they come up here. And we're going to have a conversation about this idea of when we might get into a trade, kind of putting this into practical application, because as we see, some moments to enter a trade can be better than others. And that is that point at which we get a bounce or a breakout. So, hi guys.
Hi. Whoa.
Welcome.
Oh, wow.
Welcome back up to the stage, guys. Scott Durfee, you know, Rachel Dashel, phenomenal. You might see Rachel, by the way, on the Schwab Network as a frequent contributor on a new show on the Schwab Network called Market Movers. If you're early risers and you get up early in the morning, you're going to see Rachel talking about the chart of the day on Market Movers, talking about technical analysis. By the way, here's the thing. She's got like 6 letters after her name that tells me that she's really smart and knows this stuff. I don't have any letters after my name. So, Rachel, thanks for being here.
Thank you for having me. I mean, you guys went through some phenomenal patterns. I know we talked about kind of building algorithmic trading techniques or building a plan, essentially. So that's kind of what we want to talk about today, is just how to really define our entries and our exits when it comes to some of these trades, and how to use those bounces of those patterns, finding those bounces of support, bounces of resistance, to make some hard and fast rules just around your entries and exits for your trades. So one of the kind of algorithmic type methods that we find pretty useful is Kahold and Kabold. So how many of you have heard of Kahold?
A few people, because we've talked about this. We've we've talked about this concept of whole for a number of years, and it's just an acronym, right?
Yeah.
But help us understand that acronym.
Yeah, so the acronym means the close above the high of the low day. So sometimes we see, and I know Ben and Ray, you kind of pointed out there earlier a couple minutes ago, sometimes we see that the stock tends to trade at or even sometimes below a level of support that we see there with that red candle. So that's the low day, essentially. Now, for us to know that we're going to see a bounce from that level of support that we touched, we need that method of confirmation. So that's where we typically look for that close or that most important price above the high of that low day. So we saw on that last candlestick pattern that you see there, we broke through and closed above that high of the low day, which was that touch of support. And that shows the power of that move or confirms the bounce of that level of support. So we can't tell the future, but that will give us a method of confirmation is that close above the high of that low day that shows that power move off of support.
Rachel, in the context of this bounce that you're describing, right, this support bounce, what's the significance of the close above the high, or the move above, let's just kind of make it in general terms, the move above the high of the low day? I mean, what does that signify in terms of the potential trend?
So I know before we talked a lot about levels of supply and demand. So when we're looking at the context of a trend, we have an imbalance of supply and demand when we're looking at the highs and the lows of that trend. And so if we have a move from that low bar, so we talked about also on those longer candles, there's a lot of indecision. The bulls and bears are kind of fighting back and forth. So there may be a lot of indecision there on that low day. But if we can close above that high of that previous time where there was a lot of indecision, that shows that there's a lot of pent-up demand to push us past that level that was a possible inefficiency or level where the bulls and the bears were fighting. So we have that extra level of demand there.
Okay, cool. So that gives us an idea that there's maybe an abundance of demand at that point, and we might see upward movement, and it gives us clear evidence that price is now making a new higher high in the short term, yes?
Yep.
Okay, now Scott, I want to go over to you for a second here. And I want you to take the other side of this, which is what might happen after resistance, and the acronym changes a little bit, but the mechanics is almost exactly the same, isn't it?
Only we flip it on, that's exactly right. But I want to just back up for a second. You asked Rachel, I want to add my 2 cents. So what does that mean? You know, what we're really seeing when we see a coin is, let me ask you this. Let's look at the top chart. We have a red candle, okay? And the very next day we have an up day, all right? And so it's moving up. But what are we looking for? We're looking for some sort of confirmation. And that's what you said. We're looking for some sort of confirmation. So we're getting confirmation, and it's not a guarantee that that is moving to the upside as we get that close above the high of the day. Now the resistance bound, we just honestly flip it. And so when we say kablowed, a close below the high, close below the low of the high day. So let's find the high day, okay, in the second chart, second one down, the high day is the third to the last, that big green candle. Okay, that's the high day. Now the red candle right next to it went about as high as the green candle closed, but that wick differentiates. Everybody with me?
Yeah.
So we do take the wick into consideration when we are making these types of analysis. So when we come down, we're looking at a close below the low of the high day. So where's the high day? The green candle. Where's the low of the high day? The extended wick, the extremity to the downside on that wick is the low of the high day. We gave you little cheat marks right there so you can see them. Now when we have the next candle, what happens there? The next candle actually opened higher than the prior day closed.
okay? So maybe a little head fake. Maybe when you see that, you're thinking, oh man, maybe the bulls are gonna be back in charge today. But what are we waiting for? Confirmation, and so we see it close, come down and close, so it's a close. So when we're comparing it, we're looking at the wick. When it closes, we're not taking the wick into consideration, we're looking at the closed level, so it closed below. Closed below the low of that high day. So basically the same thing.
Absolutely. So we might think about this in this way, right? Cajole is a bullish entry and a bearish exit. So if we're in a bearish trade, we might use that as an indication to get out of the trade.
Yeah.
If we're in a bullish trade, we're trading the trend, and now we get a kablode, that might be a bullish exit, but it might also be the entry into a bearish trade if we're taking advantage of that downward movement by trading options.
So just for clarity, when we say a bullish exit, that's an exit on a bullish trade.
Yes, exactly. Now that being the case, these 2 points can help us to identify what we might do at these turning points, because you notice that both of these circumstances occur at or near levels of support or resistance. So when I go back to the statement or the question and discussion that we had this morning about when do we get into a trade and being frustrated by maybe not getting in at the absolute bottom or getting out at the absolute top, this is the refining of that statement. Because now what we say is, if we're getting in on a cajole, we're getting in on evidence that the price of the stock is bouncing up off the support and has made a new low. Evidence, not guess. Because if we just get in on the low, on that low day, we don't know what's going to happen tomorrow, right? It might go lower. The bus might keep going to make it. But if we have a bounce or that close above the high and the low day, now we've got an indication that with some probability, the price is going up because it's giving us evidence of that, and we're going to spend a little bit of that price to get the confirmation. So we're not going to get in on the absolute low, but we're going to be getting in close to that low, but with evidence that price is moving higher. Now, on the other side of the coin,
Well, let me just throw this in. Aren't you glad you don't have to pick your bottom?
wow.
I meant the bottom.
Oh, the bottom price. Oh, I thought you, never mind. And if the price is going up, and we're looking at getting out when it changes direction, we're probably not going to be able to pick the absolute top unless we get really lucky. So we're going to get out when it's giving us evidence that it's moving in a different direction. Meaning, now we're going to stay on that bus to Savannah until it starts turning around. But as soon as we recognize or have evidence that it's going south, we're done. We're getting off the bus. Does that make sense? So both of these circumstances give us that kind of refining of this type of signal.
And in all seriousness, we don't have to pick where those bottoms and tops are.
Right.
We're getting that information and then getting the confirmation on that information. As we go.
Now, I've looked at a lot of different charts, and I happen to have found one that is giving us, within the space of a fairly short period of time, both of these circumstances, where we've got a close above the high of the low day, and later on, in fact, right now, it's giving us the close below the low of the high day. How many of you like the unlimited breadsticks at Olive Garden?
Oh yeah.
So we're going to take a look at Darden Restaurants, which is the parent company of Olive Garden, and there's a couple of circumstances going on this particular stock that really, I think, are clear illustrations of these 2 points that we're talking about, bounces and breakdowns. So I'm going to go with Scott first, because that's what's happening right now. So here's our base assumption. We're going to assume that we're in the trade. We're trading that stock going higher. We're on the bus going to Savannah. Okay? So Scott, what's going on in the last couple of days here on this stock?
Well,
Right up there at the
yeah,
top.
let's analyze it even below, beyond the low, just real quick, right? So we have a huge, big momentum candle coming into what would eventually become an area of resistance. We see that area of resistance begin to manifest itself when we see an indecision candle, right? The doji, when we see that indecision candle. Next to that, we see a hammer-looking candle at a level of resistance. We actually call that a hanging fan. So that's a bearish candle. So we're seeing a momentum candle, a transition candle, a bearish candle, another bearish candle that's a bigger hammer-looking candle, also a hanging man, and then we have a close below the high of the low day. So, yeah, so what is that telling us? That's telling us that there's potential bearish momentum building.
So how do we know that this is the high day? It's got the highest high of the recent trend,
Yep.
right? So the high is right up here around 202. And then we can objectively, specifically, point out where the low of that high day is, right? Right here at 199.11. As a matter of fact, if we were to put our cursor on that day, we're going to see that information displayed right here at the top. We're going to see the low for that particular day, 199.08. So we could structure our if this then that statement that says, fine, I'm in this trade, I've identified the most current high day, and I know that the low for that day is 199.08. So if price breaks below 199.08, then exit the trade,
What is it?
else
604.
wait. So now what are we waiting for? We're waiting for a close below, or some traders might use a trade below that level, and then it would be a
What
close.
is that?
That's weird.
Okay.
But
There's a lot
a
of
trade
weird
below
stuff.
that low of the
Here?
high day.
This head,
And did we do
shoulder,
that today?
head, shoulder.
Yeah.
So would this be an exit
No.
signal
So, like,
out of
right,
this
you see
bullish
this and you
trade?
see this?
If
Get
we
out.
were in the trade and trading this in an upward direction, would this be a reason to exit
Correct.
the trade?
Yes.
Yes.
There's also another alternative.
Okay.
Is
We
it
could
3
move
o'clock?
the stop.
It's gonna come back.
Oh, we could, sure.
Yeah, I mean, so when we say this game, we're
You
not
might
saying
as
you should
well.
get out
You got it
necessarily.
to 4 o'clock anyway.
But you could just move the stop loss up, and if you're in profit,
Going
if you're in
down,
a
but
profit
it's gonna
situation.
It's gonna go back up.
Particular stock, then you can potentially lock in some profit.
That's fine.
You remember those price patterns though that Ray and I just talked about?
That was for that.
Remember we
move.
talked about a bull flag?
Mhm.
We looked at those
No, I'm saying
continuation
that was
patterns.
for- that's-
So
that-
2/3 of the bull flag
You
is
just
this.
called it.
Uh,
See what they call it? It's a play
back.
already.
so if we're not in the trade at this particular point, what might we be looking for in this
No, I think
particular
it should go back
circumstance?
up.
If we've identified that this is the
It could.
current
This
low
thing go to
day,
599.
Rachel,
599.
what's the close
Yesterday,
of
same
the
as
high
Rachel.
and low day?
I
for
mean,
us?
that's why.
It gives us a new level of support.
So if we get.
Oh, so we might have a level of support right here, if this becomes the new low day, and now if we take our
Yeah, it's
cursor,
not a good day.
right? We take our cursor and we put that right here on this day, we say, all right, what's the high of the low day? The
Who shot you
most
up?
current low day,
I'm just kidding.
$200.01. If we get a close above the high of the low day,
It's
the
not
whole,
shot. Let me show y'all earlier with Spider.
that's our new
Look
entry
at
signal.
this
If
junk
price
right here,
breaks above,
bro.
if price
Look,
closes
look at
above
this move right
high
here,
of
y'all.
low day, which is
This
$201,
It
$200
went from 605
then enter the
all the
trade
way down to
else.
602.
Wait,
So Ben,
couldn't
you did mention that that's a bull
Yes,
flag,
I was
right?
in it.
Yes.
On the wrong
And
side.
so, how far back can it come, gang,
Wrong
before it
side.
becomes no longer a bull flag?
We
The
back.
answer to that question, you probably already know this, the answer, just to save some time, the answer to that question is, it can't come back more than halfway to the flag. So can we have maybe 1 or 2 days more as a bull flag? And the answer to that is yes, until we see a pattern change where we get a new level, as Rachel just mentioned, a new level of support.
so let's put this if this then that statement together here, as we put this trade together. So if this is our low day, and we know that when you move this line, I'm gonna remove it, and I'm gonna put that line right up here at the high of this, what is the most current low day. Now, if today's if tomorrow's trading or Monday's trading gives us a new low, that becomes our new low day. So the high for that low day now becomes our new bar to getting into the trade. So at this point, Rachel, our new high is of the low day is $200.01, right? So we could create an order, we could go right click, buy, and then we can edit this order and say, stop, wait, don't do anything until price gets to 200.01 or above, then enter the trade, right? If this, then that.
Who just got an aha moment? That's great.
Stop, wait, don't do anything until we get that close above the high of the low date, or that trade above the high of the low date, and then we can send that order off.
Yeah.
Okay, so that's what's existing right now. We have a load, a reason to potentially exit or manage our stop. If we were already in the bullish trade, we have the beginnings of a close above the high of the low day, potential bounce in a bull flag pattern. But I want to go back and I want to see if this is working. Because as I noticed on this particular chart, I said that there were both of these circumstances that existed at the same time in a fairly recent time frame. So I'm going to zoom in, Rachel, on this particular time frame right here. So price has been coming down, right? It was rallying up. We had this earnings announcement. Price moved up. Kind of went sideways. We didn't have a lot of momentum. And we now created this pattern right here where we have a level of, what's the horizontal level or diagonal level where price changes direction and moves up from? Support. Okay, so here's the high of our, both of these are, it's interesting because this candle right here and this candle right here have just about exactly the same high, don't they?
Oh.
Pretty close. Not
I don't know, we got
too
three.
precise, but they're that same height is right around that 182.
I know that. I know that.
We'll call it 182.67, right, Rachel? Okay, as we look at that 182.67. So in order for us to have evidence of a close above the high low day, evidence of the entry signal, Rachel, what do we have to have?
I know
This
that.
is
I'm gonna pull out.
what did we say, 180,
I'm in this
187 or 182.67. I'll just put a label here. Keep that in mind. 182.67. We'll label this so that we can see. 182.67 is the high of our low day at the moment.
Yeah.
When in this pattern did we get an entry signal or an okay to get into the trade?
Because I did out the
Big,
window.
large green candle that happens right at the end there.
Y'all gotta trade.
That
You don't
took
trade out the money.
us
What you
above
doing?
the close
Be
of
prepared
that
to
low
see
day.
it.
Did this candle give us an entry? This one right here.
No, this is
Let's
our
see.
entry right
Zoom in
here.
on it.
This is where I would have got.
That candle right there that I'm pointing at. Did that give us an entry signal?
Because you have
Nope.
three
Why
green
not?
candles going up. I
Because
am
it
no
traded
trader,
above
but
there,
listen,
but
I will
closed
get in
below
right here.
the high
And
of
then
the low day.
So we had a gap
you
up and
scared,
a
get
sell-off
out.
on that
Just
day,
stay.
right?
Stay.
What about this candle right here?
stay,
It opened above
wait the
the
course.
previous open, but it's
That
still
junk will
closed
shoot.
and
What?
it's still traded.
This
up
is
to
just,
that
but
level,
like,
but it's
I
still
this is my first time trading
closed
spy in like
below
6 months. Not
the
6
high
months,
of
I would
the
say
low
3
day.
months.
Right. Now what about
I
this
don't
candle?
know. I'm questioning.
It traded
I
above
could
its
be wrong.
open and closed above
I
its
could be right.
open, but still
I could be
below
right.
the high of the
I
low
know
day.
that
But it
ain't.
was a green
I know
candle,
that ain't.
Rachel.
I know that ain't. Let me look at this
Well, we
pattern.
have to wait for the close. We have to wait for confirmation.
They're trying, but they
It is
can't
a
get
green
through.
candle.
Come on,
Kind of candle.
shoot.
What kind of candle is
That's an
that?
indecision candle.
Give me my money back, spy.
Yeah. What about this one?
Same. Indecision
This is
candle.
But the high of the day was above our high of our low day.
But still shows there's a little bit of
Let's go.
indecision, and then we
Come
have
on.
to see the difference between
No.
the open and the close is also a very short distance as well, which shows the pressure of those buyers and sellers, even more indecision before we have that power move and that break of resistance.
And then what about this day right here, the one you pointed out? What does that tell you?
She better
Beautiful,
drop to
that's
the
our
ground.
confirmation, that's our break, that's our goal.
Momentum.
Drop.
Yeah.
Wow. Cool.
Big
Let
can.
me bring that back down and go back to our chart.
This is too much anxiety.
Let me ask you this.
I just,
Do you think,
I'm going on.
because many of you raised your hand when we asked the question earlier, you said, I'm having trouble or I'm struggling with determining when to enter a trade.
Right. Yeah.
Could structuring your entries around this idea help you to make better entry decisions?
Yeah.
Because now you have an objective, evidence-based way to get in the trade. You don't guess. You're not hoping, wishing, praying that the stock is going higher. You have evidence that it's going higher. Right? Could just that fact help to improve your success in getting into it? Yeah. Isn't that cool? Now, I'm curious
No,
about
yes,
something
that's
here.
what you need. You need
I want to go back to what Ray and I were talking about, that symmetrical distance. Oh, question, was there a question? Yeah. Oh, good question. Really good question. So the question was this, well wait, if this is our entry signal day, right? That's our entry signal day, at what price do we end up buying or getting into the trade?
goes by.
So part of that goes
I'm gonna
back
watch it.
to
I'm
the
gonna
name,
Deal.
right? There was one of those TV chefs that's kind of aggressive and a little bit acerbic, and he had this great commercial where he says, somebody's asking him, how do I make a grilled cheese sandwich? And he yells at them, he says, the recipe is in the name! Grilled cheese sandwich, you grill the cheese and put it in the sandwich. The recipe for what our entry point is in this trade is in the name. Close, above, behind, floating. So our entry into this would then, realistically, if that's what we're following, be the closing price of that candle or close to that close.
Well,
Yeah.
So, real quick, look what
Yeah.
happened though, and this is what will sometimes freak us out. I get in on that high day, close of the high day, and then look what happens the next few days, 4 days in a row. It closes below where we get in. So for 4 days, you're thinking, you guys know what we're talking about.
Yeah.
But then look what happens. So keep that in mind, remember stocks breathe, you're gonna have that up and down.
Now let's talk a little bit about kind of living in the real world here, because we know that not all of us have the ability to, or the desire to, sit here and stare at your computer all day long waiting for that entry, right? So we do things like putting a buy stop order in to help automate, right? Now Barb teaches a webcast on Wednesdays called After Hours Analysis, which is designed to help those of us who have jobs and can't look at the market during the day make a determination
girl.
on how we might enter
Just
and
go there
exit
so you can bounce.
while the
back.
market's closed. What are we going to do tomorrow? What are we going to do over the horizon? Right? And the idea is we may want to wait for that next day's close to have validation of that signal. But there's something else that we can do. We can say, well, generally maybe the last 30 minutes of the trading day is probably, more often than not, no guarantees, but that's probably going to be pretty close to that closing price. Watch this. This is kind of cool.
This is very cool, so pay close attention.
So what if we do this? What if we create our trade? And I'm going to use this one as an example, this most current example. The market hasn't closed yet, but we're going to use this and we're going to specify kind of this if this then that statement. So what do we need to see happen here in order for us to get into the trade? Close above the high and low day, which we said was $20 or $200.01. So we're going to create that order. We're going to right click and we're going to say, fine, I'm going to buy and I'm going to edit this order. And I'm going to say, okay, I want to get in on a buy stop if the price of the stock is at $200.01 or higher. That's what this buy stop order says. Stop, wait, don't get in until that circumstance occurs. But I don't have a closing price yet. So what if I did this? What if I come over here in this order entry line? And again, I'm not going to get deep into the mechanics of where you find this. We've got some great resources to help you use the order entry tool. But I'm going to click on this little gear icon, and I'm going to come over here and I'm going to say, fine, submit this order at 30 minutes to go until the close of the trading day, so that I can take advantage of getting into the trade as long as it's giving me that particular signal. So you might make this, so we close it at 4:30 or 4 o'clock here on the East Coast. So that's going to be 16:30, right?
At 3?
4:30?
15:30. 15:30. All right? So submit this order 30 minutes prior to the close of the day, the close of the trading day, which gives us that closing time frame, and then click on save. And now, this is the conditional order. Oh, I'm in Mountain Time still.
Yeah, you're
But
on Utah time, so you're gonna have to adjust.
we're creating this as a conditional order. It says, if it's in the last 30 minutes of the trading day, and price is above $200.01, then enter the trade, else wait.
Well, Ben, you can do it, just back it off 2 hours. Put it
Yeah,
in.
we'll back that up.
Yeah.
We'll go back and we'll adjust it, right? Okay, so we'll make that 30. Okay, and so we'll enter the trade at that point. All right. Anyway, time differences notwithstanding, that's how we would go about creating that particular entry circumstance into this scenario. Now, I want to do one more complex scenario here while I've got Scott and Rachel. I was saying Rachel, thinking Ray, and looking at Scott. So while I've got Scott and Rachel up here on the stage, I want to put this trade together because I said I was kind of curious. So look at the move that the stock made off of this last earnings day, right? So we went, oops, I'm on my labels. Let's go to our trend line. If I went from here to here, that's the flagpole portion of this most recent bull flag, and I right-click and duplicate that, and I put that flagpole right up here. We got pretty close before it pulled back. Now, one thing I happen to notice is that this first portion of the flagpole, zoom back out, that first portion of the flagpole was driven by what kind of announcement? An earnings announcement. So I know that I'm not going to get another earnings announcement on Darden for another 3 months, so I might take that distance and diminish it or attenuate it a little bit. So I'm going to come to that level of support that was there,
No. Here
and
they
I'm going to
go.
draw my line from that level of what was resistance. I'm going to draw that up to my resistance up here, where that resistance gets created and tested. I'm going to right-click, duplicate, and I'm going to take that, put it right here on that breakout. And we're pretty darn close. We're within that big fat magic marker of that resistance level. So now, what does that mean? So that now says, let me kind of zoom back out here. That now says if we have this next entry into the trade, right, that close above the high of the low day, could I do this? Could I duplicate this drawing and now put that right there and say, fine, here's my next likely level of resistance overhead, 223. So I want to create a complex order, if this then that statement, really quick. And then we'll use this to kind of snowball into some of these other examples here. So what if I did this? What if I said, fine, we'll do the same buy stop that we did before. Oh, and by the way, what does this level now become if we get a close above this, the high of this low day? What does the low of that be?
Support.
Support. So when might we exit a trade?
Yeah.
If it
Takes
breaks,
expensive.
support? Okay, so let's do this. I'm gonna draw that level of support in here at 198,
I'm just. Let's see that.
right about there. So now let's put this trade together. Right click, buy custom with OCO brackets. Somebody else mentioned OCO bracket orders before, right? We talked about those as being kind of that if this then that statement. So here's what we're gonna do. We're gonna say, fine, stop, don't get into the trade until we get that close above $200.01. And then if we're in the trade, exit if the price of the stock goes up to 224, and we're going to make that one good till cancel. Rachel, tell me what good till cancel means when we're placing an order like this. Oh, you might not. Oh. Can you turn the switch? Oh, I think you're on. I think maybe you're bad. No, there you go. Now you're better.
Okay, everyone can hear me now, right?
That's better.
Okay, so a good till canceled order, it's going to be by nature good for 6 months or until you cancel the order. So by default, you'll see that it's good for 180 days, or until you go in and cancel the order, or until one of these orders gets filled, and then it's gonna cancel out that other order.
And now we're going to do that good till canceled order on our limit order, which is sell it at this price or better, 224. And then the other side of this trade stop, we're going to do a stop order. If it goes down, 198, we'll make this 198. I'll make this kind of an odd price or a different price, 84. Something that's a little bit different than maybe a round number or a 5 or a 0. Something different so that we're not in a place where other traders are likely to put their stops.
Yeah.
We're going to make this 198.84 and we're going to make that good till canceled down to stop. I'm doing this as a stop order.
Yeah.
Tell us really quickly what the challenge to placing a stop order might be.
The challenge to placing a stop order like this, there's a couple of challenges. So first, let's go to if we were to make it a limit order. If we were to make that a limit order at 198.84, it would have to hit 198.84, right?
Okay.
And so it could gap around that. And if it gaps around it, are you going to be out? The answer is no. And you want it to be. So Ben's using a stop order here. So let's just review what that means. That means that if it comes down, hits 198.84, it says stop. And then it activates a market order, which will get you out at the best price possible, closest to 198.84.
And if the price of the stock is just tanking and going down fast, there's a possibility that it could be activated at a particular price
Yeah.
and then fill at a price that is lower. That's the risk of using just a stop order or a stop limit order where it maybe gaps around that level. Tomorrow, we're going to talk about some methods that we can use, options to kind of mitigate some of that challenge or consideration when using a stop order. So here's what we have. We have an if this then that statement. If price moves above $200.01 and closes there, then enter the trade. Else wait. And then if that happens, if price goes up to 224 or higher, then exit the trade. Or if price comes down to 198.84, then exit the trade. Else wait. So we've got this if this then that statement that is now much more complex than just get in on a bounce off of support.
Yeah.
And we're going to go ahead and we're going to hit confirm and send. We're going to read through the order. Always important. How many of you like to measure twice, or measure once, cut twice, swear a lot, and then go to the Home Depot and get another board?
Whether I like it or not, my
Right.
wife says that's what I do.
That's exactly what happens. So read the freaking order first, and then place the order.
Yeah.
So we're gonna read through that, make sure that that's what we wanna do, and then we're gonna go ahead and, I'm gonna put this in our Atlanta workshop, and we're gonna click on send. Now you can see those orders in place here.
So now what's gonna happen is if it goes and hits one of those orders, for example, one of the red orders, let's say we get in, and then it hits stop, okay? What's gonna happen to the limit? It will go away. That's the one cancel stop, okay? And vice versa is also true. If we go up and get stopped out at top, it doesn't leave us in a situation where we could be short stocked because it would cancel the stop.
All right. So what we've learned from Rachel and Scott is that there's some better times to enter a trade.
Yeah.
Or more prudent times to enter a trade based on that evidence.
Yep.
That might be a time to exit the trade to close above the or below the low of the high day. But that also might be leading us into a potential new close above the low of the high, or close above the high of the low day.
Easy for you
A
to
new
say.
to hold entry into the trade. Let's give Rachel and Scott a big round of applause. We're going to close them again, especially tomorrow as we start. We're going to bring Rachel up and talk about cover calls tomorrow. But what I wanted to do really quickly here, right now, is simply this. Because some people have asked the question, right? You know, we spend all this time talking about basics, and we talk about building this if this then that algorithm, and we understand we have all these resources that you can learn about more ways to extend your learning and your understanding. And we do it in this nice room, and we've got some great support staff, and we've got resources like our webcasts and our branch partners and our trading solutions folks, and Rachel and the Retail Investment Strategist group, and all of our partners. Why you guys do this and you don't charge us for it? Because I don't want to pay. Give me your money, right? Take my money. Here's the reason. We like you. We really do. I mean that 100%. I mean that sincerely. We like you as clients. Look, the absolute 100% reality of the situation is when you make money and grow your portfolios, we make money. Period, end of story. But we like you as clients. We like you being around. We're here as partners for you in growing your portfolio, in building that legacy that you are putting together and amplifying so you can leave your kids, your loved ones, to the community around you. And we found that by helping you to make informed and educated decisions, by providing you with resources to learn about things, that you can be around as clients.
I called them before I started.
Which is great, because we like you. So that's why we do it.
It's actually
Now, we have one simple ask. We didn't ask you to pay for lunch, we didn't ask you to pay for parking. We invited you to be here, but we have one simple ask from you, and that is to help us to make these workshops better for you. Help us be our partner. Click on that QR code or type in the link there at the bottom. It's 2 questions. It takes just a couple of minutes. Fill out that feedback survey and help us to make these workshops better for you. And then once you've done that, then go and refresh your beverages and take a biological break, and we'll be back at 10 minutes to, and then we'll go into our last segment of this discussion, and we'll finish up about 9 o'clock tonight. How about that? All right, we'll see you in a few minutes.
You know what I think would have been better is for the last hour of the session, we could have traded live in our simulation. Oh. They could show us how they.
I mean, you good?
Thank you so much.
charger for his phone. He's like, one charger for his phone, his computer. What now? His portable charger. Now that I'm looking, can you go regular C-charger? Yes, but it doesn't charge as fast. It doesn't charge. But still, it would stay. It will stay on. Same thing for laptop. I told you that. It's regular C-charger. Oh, for my Mac too. Yes. But they're just a little different. I will be on it. That's all you gotta do. It's very calm. It's comfortable. I still get licked though. But yeah. Okay. This is everything. I hate to do it, but fortunately, I'll come back to the lesson. Let me think.